It was said by Warren Buffett that you can only see who is swimming naked when the tide is out. The investment guru meant to say that the only time serious investors succeed is when the economy is weak. When conditions are favorable, it is simple to disregard every caution. Almost all investment options do well during this period, and investors earn profits. But when the economy is in turmoil, investors really realize how important it is to use the fundamentals of investment. These ideas are so crucial, but only a select few members of the elite are aware of them. And there has never been a better time than now to start learning how to invest. The pandemic's after-effects and the uncertainty surrounding a potential world war have caused certain aspects of the economy to collapse, although some extremely wealthy people have nevertheless seen their wealth increase. How did they accomplish this? We're going to share 15 investing principles with you today in video that will help you start investing like the wealthy. So be sure to gather a notepad and paper and stay tuned until the very finish. So, before we begin, give this video a like and welcome and subscribe if you are new here. Now let's begin, shall we? 15. Have a personal financial roadmap. The very first rule is to fully comprehend your financial status. This is crucial if you've never put together a financial plan. You must assess your existing financial situation, decide how much risk you can tolerate, and set goals. This is where you must start, whether you're working with a professional or on your own. One crucial consideration that you must always bear in mind as you proceed is honesty. As cliché as it may sound, you must be as honest as you can. While it is not guaranteed that you will recover your investment, if your roadmap is well written, there is a good possibility that you will. 14. Invest early. Early investment has been shown to be more profitable than waiting until you have a large sum of money to invest. Begin with what you already have and gradually expand your portfolio. By making an early investment, you can benefit from compounding. If you didn't know, compounding is the process of making more money by spending the money you have already made. As a result, in addition to what you invested, you will also profit from any accumulated capital gains, interest, and dividends. A 2-year investment discrepancy could result in thousands of dollars in potential losses. 13. Diversification. Most successful investors and financial managers have mastered the art of diversification. It's a good idea never to put all your eggs in one basket. Although it might seem obvious, you'd be shocked at how uncommon common sense is when it comes to investing. Diversification is a rather easy process. It implies that you select multiple investments rather than simply one. Your risk is reduced if you have a variety of investments. Consider the following scenario: if you invest in a firm, and the company goes bankrupt, you could lose a significant amount of money, depending on the sort of share you own. Make sure you choose a diverse range of investments as you diversify. Throughout history, several asset categories have never increased or decreased at the same time. This means that when equities decline, bonds may be rising or falling, but never at the same precise rate. However, maintaining a portfolio ensures that your losses are kept to a minimum. 12. Leverage is key in building wealth. Obtain leverage to generate sizable fortune. You are only as wealthy as your resources, thus if you want to accumulate enormous money, you'll need to look for some leverage. There are various ways to use leverage. Financial leverage refers to the use of other people's money to raise the amount of money that is available and grow one's wealth. As you only have 24 hours in a day, in reality, it's more like 16 since the other 8 are presumably spent sleeping. Time leverage is the use of other people's free time. Since you are not an expert in every area of investing and someone else is, knowledge leverage is the utilization of another person's knowledge. 11. Be vigilant of scam. Scammers are everywhere, and they are constantly seeking for their next victim. Don't be one of them. These con artists frequently leverage widely covered news stories to entice investors. They frequently offer opportunities that are too good to be true. Ask as many inquiries as you can and demand official documents to avoid being a victim of such. Include a lawyer in the process of evaluating the entities before investing. 10. Cash is the king. The pandemic has, if anything, highlighted the value of having a cash reserve. Make sure you have a cash reserve before forming any financial plans. The reserve should cover expenses for 3 to 6 months. To get an idea of how much money you spend each month, start by writing down all your costs along with the quantities. Those who had savings when the pandemic initially began were probably less impacted by the economic crisis. The reserves allowed them to cruise through the choppy waters unharmed. Economic developments are beyond our control, but we do have control over our emergency savings. Make sure you have the money saved up in a secure location in case anything unexpected happens. 9. Deadly debt. Debt has positive and negative aspects, according to advisors. It does, indeed, have both benefits and drawbacks. Debt is beneficial if you're investing the money rather than utilizing it to pay bills. Most wealthy people grow their wealth through taking on debt. But, individuals who are entirely debt-free are those who are in the best financial health. Even seasoned businessmen and investors can run into problems if their debt burdens aren't carefully maintained. By taking on debt, you are expected to make your payments on time and always adhere to the terms of the agreements. Anything could occur that would prevent you from making the repayments on time. If you must borrow money, do so, but only for investments rather than to pay for daily expenditures. We are not wholly against debt. Create a strategy to pay off your debt as quickly as feasible if you must take on debt. Your revenue sources may not always be sufficient to cover loan repayments. A prime example is the conflict between Russia and Ukraine, where people who owe money are still required to return it, notwithstanding the circumstances. They still must pay back their loans despite the fact that the majority of them lost their employment and moved to other areas. 8. Time frame is the key. Before putting together an investment portfolio, it's critical to comprehend your time horizon. You may maintain perspective amid choppy market situations by being aware of this. A long-term investor, for instance, does not fear a bad market. In fact, it offers a fantastic chance to trade at lower prices and earn profitable returns over time. See how developing a strong investing strategy is aided by being aware of your time constraints. Building a portfolio without knowing when you would need the money is unwise. $7 cost averaging. This refers to the practice of routinely funding investments at predetermined times. Depending on your capacity, this can happen every week or once a month. Sports, politics, the environment, and other topics can elicit strong emotions in some people. Therefore, it makes sense to feel strongly about your assets. However, the reality is that judgments made on an emotional level nearly never turn out well in the realm of investment. But by putting up an automated investment strategy in your accounts, you may take emotions out of the equation, lessen your urge to time the market, and gradually accumulate wealth. 6. Rebalance. The buy low and sell high notion is the foundation of rebalancing. To benefit from the changes, it entails changing the weights of the assets inside a portfolio. By using this technique, you can simultaneously buy positions whose value decreased and sell positions whose value climbed. As a result, the initial asset allocation in accordance with the portfolio holder's risk tolerance can be maintained. 5. Conservative bonds are a safe haven. Many investors ignore reputable fixed income sources when the markets are booming. The high-flying technology stocks are in strong demand. There's nothing wrong with that, so don't worry. But in truth, turbulence frequently appears when the market is performing well. Yes, you will have some returns, but how long until a decline? Bonds have a role in this. Bonds are essential to portfolios for many reasons. They act as a buffer for volatile markets by allowing investors to sell an asset without seeing its value fall. And it is short-sighted to disregard bonds as a primary investment strategy. 4. Returns and risk go hand in hand. Every investor out there is diligently looking for the choice that offers the biggest return with the lowest risk. Finding the right balance is difficult because the danger of losing an investment increases as promised returns increase. Risk could manifest in various ways. Illiquidity, bad credit, or leverage are all possible causes. The inability to quickly turn an asset into cash is referred to as illiquidity. The state of the economy is also quite unstable and a major factor in determining the rate of return. Therefore, while you invest, keep in mind that every lucrative opportunity has a high degree of risk. 3. Boring always beats exciting. People enjoy exciting things, and they frequently choose the next greatest product available. Between an exciting chance and a real opportunity, though, is a fine line. And most people miss it. Most investors mistake an intriguing concept for a wise choice of investments, as you will see. This excitement is frequently wrapped up in the newest craze, a revolutionary new company strategy, cutting-edge technology, or even a special offer. Most people concentrate on the buzz rather than the basics. Keep in mind what we said before about allowing feelings to influence financial choices. Perhaps you now get the idea. Stick to the dull, conventional investments to avoid being seduced like a toddler by candy. This might be high-grade bonds, blue-chip stocks, or index funds. Although you could lose out on the upcoming hot IPO, you won't miss out on consistent gains. 2. Keep an eye on fees and taxes. Brokers charge commissions for each transaction. For every sell or buy transaction, fees range on average from 2 to 5%. Before choosing a broker, make sure you compare their commissions as they differ. Furthermore, capital gains tax may lower your overall earnings. Examine the laws in your jurisdiction before investing to learn what taxes are owed on your winnings. 1. Move on from the stock markets. Once you succeed, addiction to the stock market exists. A common comparison is with gambling. Once you start earning well, you'll constantly desire to increase your income. However, once you have amassed a sizable profit from the stock market, you should consider selling to avoid sharp market declines and the anxiety that comes with waiting out bad markets. You see, even though they may not offer returns as attractive as those offered by the stock market, you may always look for other investment opportunities with reliable returns. I appreciate your attention. If you're still watching, I'm guessing you liked the video. Make sure to subscribe if you haven't already because we produce educational stuff every other week. Give this video a thumbs up as well and let us know in the comments the investing principle you took away from it. Enjoy your day.